Hey everybody, Dan Rawich here. For those of you that listen to my podcast, I've been talking about options trading. Many of you have followed me for the last 10 years or so with RateWatch, and I think listened to my recommendations over the years, and I've had a pretty good win rate. I'm not bragging, it's just when you do something for most of your life, you probably ought to get pretty good at it. And so a lot of you that know through my podcast, I recently kind of semi-retired. And one of the things that I'm doing is options trading, which makes sense because it's back to my roots. It's what I love doing, and I just haven't made time to do it for the last few years. Although I've kept my axe sharpened, through RateWatch every day as studying the markets. That's never stopped, and I've done some casual trading, but now I would say I'm kind of moved more into the role of serious options trading. And I wouldn't say I invented many of the things I'm going to talk about. In fact, I didn't. Maybe I've perfected them for my own usage. And my goal in options trading has been quite simple. Minimize risk at all costs and maximize profit. And I will trade profit for risk any day. I would rather make $1 and lose 50 cents and to have the chance of losing 50 cents than I would make $5 and have the chance to lose $2. Because there's an infinite amount of trades you can take, and there's really no reason to step out of your comfort zone and take risks. A lot of people have heard that options trading is incredibly risky. When you sign up, your brokerage firm will tell you that. I suppose if you went in blind and didn't know what you're doing, you could lose your shirt. But if you go in with your eyes open, you take calculated trades, and every single trade has a defined risk and a very well-defined and pre-executed exit strategy. When you do those things, you most likely will win way more than you lose. So I've just used July for example. The 23rd today. We've had 85% of our trades have been winning, and the account's up, I would say, close to 20% just for the month of July. So that's pretty cool. So I want to talk about that. And I want to be transparent here. Although I love to help people, you guys know that I've done RateWatch and never been paid for it for 10 years. And I try to help as much as I can. That's just something that interests me. But also now that I'm semi-retired and I am trading, and so many people have asked, hey, can you teach me how to trade? I thought that there's probably a business model here. So my thought is, again, I guess I am pre-selling a little bit, but it's not well thought out, is to come up with a strategy where anyone that wants to follow me, they can follow me daily while I'm trading, or they can follow me twice a week. Either way, we'll place very specific trades. We'll explain every trade that we're taking. You'll watch me trade live. You can decide whether you want to trade along with me. Maybe you'll do paper trade for the first few weeks, which I like to see people do. But hopefully you'll take the trades alongside me. You'll get in when I get in. You'll get out when I get out. You won't have to sit by your computer and watch the markets because you'll get alerts from me when you got to get in and get out. And I'm thinking somewhere around 150-ish per month, and with a guarantee that if you don't double the money that you're paying me, you won't pay for the following month. So in other words, you pay me 150. If you don't make 300 that month, the next month you don't pay me 150, and you still get to trade alongside of me. So pretty risk-free, I think, and that just goes to the level of confidence I have in what I'm doing here. So I want to start with a quick intro, just to whet your appetite and see if this is something for you or not. So first of all, there are 4 different directions to trade options. It can get confusing, and a lot of what I'm going to say is going to sound like a foreign language, but only now, because a little bit of what I'm saying will stick, and then a little bit more, a little bit more, a little bit more, and before you know it, you're going to say, oh my gosh, I got this. And the only way you can get this is by doing it, or at least in your head, pretending like you're doing it right alongside me. Like literally a piece of paper that says, I just took a pretend trade with Dan at this price, and then putting on that same piece of paper, I just exited this exact trade with Dan, and I made this much money. So you do that for a while. It's amazing how the knowledge will just become anchored within you. My point here is please do not get overwhelmed. There's going to be terminology. I feel like one of the things I've done pretty well over the years, at least that's what you guys have told me, those that follow me on RateWatch, is to try to break down complex things and make them as simple as possible. This is one of those things, it's not completely possible to make it like, 8th grade knowledge, but I'm going to do my best here. But bottom line is, please don't feel overwhelmed when you don't understand something. Either ask or just know it will come to you the following week or by the next thing that I say to you. All right, so there's 4 directions to trade options. Today, we're only going to be talking about puts, and we're going to be talking about selling puts. So the 4 directions is, I can buy or sell a put, and I'll tell you what that means soon, or I can buy and sell a call. So there's your 4 directions. And believe it or not, I can sell either one of these even when I don't own them, and that's considered going short. That's probably the most complex thing to get into your head, is how can you sell what you don't own? We'll get into that more in a minute. And then you can also do more complex trades, and oddly enough, the more complex these trades get, the less risk is in them, because you can literally take buy and sell at the same time. So I can buy a put and sell a put at the same time at different prices. And again, that gets more complex. We'll get into that later. But when I do that, I can exactly define the most I can lose on a trade. Even if I did nothing, even if I went on vacation for 2 weeks, walked away, never looked at my computer, market went to hell, I know that I will only lose $100 on this trade. On the same token, when I lock in my loss, I've also locked in the most I can make. Now, I typically try to go for 3 or 4 to 1. So if I'm going to lose 100, I try to make sure it's a trade I can make 400 on. If you think about it, that way your win ratio doesn't have to be that high, because you're making so much more money on your wins. But like I said, we're about 85% wins this month, and I would just say over a longer period. But this is a month I really started tracking for the purposes of teaching. Okay, so how do you sell what you don't own? If I sell a put, I'm confident that the stock is going to stay the same price, or it's not going to go down too much. If I think that stock's going to go down, I'm not going to sell a put. I'm going to buy a put. Okay? So puts, if you own a put, if you bought a put, you're pretty confident the stock's going to fall. If you sell a put, you're pretty confident the stock's going to stay the same, go up, or at least not fall too much. And these are pretty low risk puts I take, and I'm going to actually show you some actual trades if you stay with me for a minute. All right, so I get paid the moment I sell that put, and that's kind of fun. So let's say that XYZ company is currently trading at $100. That's not the option price, that's the actual price of the stock. Because an option is only the option to buy or sell that stock at a certain price. So options trade at a fraction of the price of stocks. And that's why people like trading options. There's much more leverage. So if I believe XYZ company, it's trading at 100, and I believe it's going to stay above $90 between July 1st and July 20th. I made the trade on July 1st. So when I sold that put, I gave somebody the right to put those shares to me at $90. So in other words, if the stock were to fall horribly, and maybe it went from 100 to 80, the guy that bought that put from me, that paid me money the day I sold it, he can make me buy those back for $90. And now the stock's trading at 80. We don't want that to happen. That won't happen, and I'll share with you why. Well, it could happen if you didn't do the right stuff here. So I got paid, in this pretend case, $1 per share for the option that I sold. And I sold 500 shares. So basically I got paid $500 the moment I took this trade, which is opposite of anything you've ever learned or done, and it's kind of fun. So the way it got to be 500 shares is each contract to sell these puts is 100 shares. So in options, a contract always equals 100 shares. So in this position, I felt good. I sold 5. I could have sold 10, could have sold 1, could have sold 100. In this case, I sold 5, and I got paid $500. Okay? Fun. Now, if the stock stays between $90 and $100, or goes up, it could go to $1,000, it doesn't matter. As long as it stays above $90, by July 20th, which is the expiration date of this contract, so I sold the contract not for an unlimited time. I said, hey, mister, pay me $1 per share, and as long as and I'll buy that stock back from you at $90 anytime you want, up until July 20th. Well, of course, they're not going to want me to buy the stock for 90 unless it falls to like $89. So back to this point here. If the stock's trading at $100 and I sold this option at 90, I'm pretty sure the stock's going to stay above 90 until April 20th. And those of you that follow me on Rate Watch probably know I've gotten pretty good at reading charts. They talk to me. And what I love is you've gotten pretty good at reading charts. So if you are a Rate Watch fan, I think this is going to be pretty good for you. Because you can look at the chart and you can see where the support and resistance lays, and I will show you that in a second as well. Okay, so stock stays between 90 and 100 or goes up to whatever. Stock goes above, stays above 90. By July 20th, I keep the whole $500. Now, I don't have to wait until July 20th. If the stock were to go up a lot from the $100 when I first sold the option, well then the value of that option is going to go down. So I'm actually going to read this because it's very confusing to say. So if the stock goes up, the option goes down. This is good, and it's hard to understand. The reason it's good is I sold the option for $1. I got paid $500, right? If the stock were to go to, say, $105 when I sold the stock was $100, then the option price would go down to 50 cents. At a quick glance, you'd go, well, didn't you just lose 50 cents? No, I didn't, because I sold it already at $1. Now I get to buy it back for 50 cents. So the net effect was that I sold something I didn't own for $1 a share. It gave me $500. And as the price of that stock went up, the value of the option went down, and I got to buy that option back for 50 cents, which cost me $2.50. So I was paid $500 when I opened the trade. I spent $2.50 to close the trade. My profit was $2.50 in just a few days. Or I could hold the position till expiration and keep the $500. What I typically do is when I see a 50% or greater profit, so if my total gain in the trade was $500, if I hold it till expiration, anytime I have $2.50 or more in the trade, I'm going to buy back that option and close it out. This is still Greek to you. I get that. But a little bit is going to seep in, and when you see what I'm talking about, I think it'll help you a lot. The bottom line is I sold what I didn't own with the obligation to buy it back. Okay, that's called selling short, and that's what a put is. Now, what I just did is I sold a put, and I didn't have something on the other side of that to protect me. So that's called a naked option. Now, Wall Street will tell you that selling naked options is the riskiest thing you could do, and it is if you don't protect yourself. So let's say this thing goes the other way. I talked about the good side, where the stock went up, the value of the put option went down. I got to buy it back for way less than I sold it. That's cool. Now, if the stock were to fall dramatically, then the value of the put actually goes up. Everything's inverted here. So it's called a put option because whoever bought that and paid me the $500, they have the right to put the shares to me at $90. So if the stock fell to 80, whoever owns that contract that bought it from me could force me to buy those shares at $80. Buying shares, at $90. They get to make me buy them at 90. The stock's trading at 80. That would be a big loss, wouldn't it? That would be a $40,000 loss. Ouch! It's not gonna, or $50,000. It's not going to happen. And here's why. If I were paid $1 per share or $500 for the 5 contracts, I would immediately, the moment that trade was executed, put in an order to buy back the shares at a max price of $150. So if the stock did fall and the cost of the option started going up, what I sold for $500, I'd have to buy back for $750. So it's $1.50 a share times 500 shares. So I sold it. I got paid $500 the day I took the trade. I didn't like the way it was going. I already had a stop loss in. So as soon as the price of that option hit $150, Wall Street takes me out of the trade. In this case, it would have been a $250 loss. So the reason I picked that stop loss was that's a 50% loss, 50% of the 500. So in this case, I could make 500 if I let it run, or I could lose 250. That's the most. Think about this for a minute. If I only won 50% of the time, but every trade that I won twice as much as I lost, here's how that looks. If I were wrong half the time, if 5 trades win and pay me $500 each time, I got $2,500. If 5 trades lose and I had to buy those back at 50% loss, I lost $250. I still made $1,250 or $125 a trade, even though I lost half the time. It's not likely that I will ever lose half the time, and I'll show you why now. Let's look at a couple examples. Hang on here. Bear with me. I'm going to be juggling between a lot of screens here. All right, so let's look at a trade I took this morning. This is called Decker Outdoor. The symbol is DEC. The stock is currently trading at just under $117. It's down about 84 cents on the day. Okay, so what I did is I sold a contract that somebody can make me buy the shares if the stock drops below $97.50. So I make money even if the stock trades almost $30. What is that? $27 drop in price. I still make money on this trade. I don't need it to go up. It can go down. It can go down a lot. So how did I pick this price of $97.50? Pretty simple. If you've watched me over the years, you've learned how to read charts. Even if you haven't, I'm going to show you right now. What's happening here is Decker is trading in a pretty defined range and has been since May. And that range has been a very high of 123 and a low of 111. Not much has happened to break it out of that. Now, so this line here is called support. There's a lot of support at 111. It's been tested several times. If it were to break support, the next level of support you can see here would be $105. I'm still $8 above my risk price. It's called a strike price. So the next and the biggest support level I can see, bigger than most support levels you'll find, happens to be at $98. So I feel really confident that this stock got creamed, something horrible happened, their earnings came out, whatever, that this stock, first it will hold 110. Then I really believe it will hold 105, and I believe the worst case is it'll hold 98. If this holds between now and when this option expires, then I make the price of the option. That could be $500, could be $1,000, whatever I sold that option for. So that's what that looks like. I next wanted to show you just kind of a detail of some current positions that I've got. So this is just one of my accounts. This is the account I'll probably use for demonstration purposes. And the reason I want to use this account is right now every trade in this account was a put that I sold, and we talked about that already. And so if you can look, this doesn't show you the dates I took the trade. It just tells you when the trade expires. So let's go through a few of these, and you can see what they mean, and I'll show you what they mean. So this stock CZR is actually Caesar. I sold a contract that would obligate me to buy these shares at $9. So if the stock were to drop to $8, somebody could make me buy these shares at $9. I don't want that to happen. Now, I bought these shares. I got paid. Remember, I sold this. I sold this to somebody, a contract that they could make me buy back. I sold it for about 19 cents a share. What did I get paid here? I don't remember how many shares I took. Oh, I bought 10 contracts at 18 cents a share. So this trade is smallish. The upside is $188. That's the upside. because I got paid about 19 cents times 10 contracts, which is 100 shares each contract. So that's basically 1,000 shares at 18 cents. $188 is the win. But for a minute, just because that gets confusing, just know that I sold these for 19. I could close this trade right this second and buy back the shares I sold for 18 for 9 cents. For an $88 gain, again, this was a small position, cheap stock, and a 47% return on my investment in the last 2 weeks or 10 days, I think. Now, as long as the stock stays above $9 between now and September 21st, if it at September 21st, this guy's contract to make me buy these expires. He can't make me buy them anymore. His contract expires worthless, but for me, it expires with a profit of $188. Okay, let's look at another one. DEC. This is the trade I told you that I took this morning. So there's not going to be much action here. We did see that the stock was down a little bit so far. So that'll be good. You could see the impact of that. Now, DEC, I sold an option to some unknown guy that he can make me buy these shares at $97.50 between now and August 17th. Okay, This is about as far out as I like to go. I took some further out trades, which I'll explain at another time. But this is kind of where I like to be. So, and I showed you, the stock is currently trading at like 120 bucks. So it can fall a long ways. So I sold these shares to some dude for about 64 cents a share. So if this stock stays above 97.50 by 8/17, I'll make $640. And what you can see right now is I could buy these shares back at, where'd it go? So I could buy these shares back right now for 62 cents. So basically, I've made a penny on this trade, which is not a lot. It's 13 bucks, but it's 2% in about 2 hours. It doesn't mean anything though. The trade is new. We got to let it run. The next trade. Oh, before we go too far into this, I want to show you a couple of super important things. So, Decker, you know that the stock's trading at about 120. I gave the guy the contract all the way down to 97. So that gives me a lot of play here. Caesar, I sold the guy the contract at $9, and you can see that Caesar right now is trading at almost $12. So there's a 30% margin in this stock that it can hold. Now Caesar, let me close this again. I lost my other chart. Sorry guys, hang on. Let's open this back up. I could sell right now. I don't have to keep this till September 21st. I'm up for what I showed you. Let's go back here, sorry. So I sold them for 19. I can buy them back for a 9-cent profit right now. That's about almost a 50% profit. So I'm real close right now to being able to close this trade out at my 50% profit. Or I can decide to hold it for another 2 months, take 2 months of market risk to make another 80 bucks. No, I'll probably close this trade out in the next day or so. Let's look at EMR. This is Emerson Electronics. The price that I sold the contract, so somebody can make me buy these shares for 50 bucks between now and December 21st. I sold these shares for 23 cents, and I currently have a 4-cent profit in these shares, meaning I could buy them back for about 19 cents. So 4 cents per share, and the amount of shares that I own, it's a very small profit. It's $38, but it's still 16%. Again, this trade's about 2 weeks old. But here's what's important. This contract's at $50. Let's see where Emerson is. Emerson is at $67. So this stock would have to fall by $17 for me to lose money. Not very likely to happen. I don't want to take too much an excessive time on this first video, but if I did, I'd show you the chart and you'd see there's a lot of support well before we get to $67. Okay, it's going to go through a couple more and then I think that'll be good for today. Let's look at, I think this is my oldest trade. Let's look at Oracle. Oracle, that's a company you all know. I sold the right for somebody to make me buy shares at $34 between now and December 21st. I sold that right for 28 cents. I currently have 18 cents profit, meaning I could buy these back for 10 cents a share. So I sold them for 28. I can buy them back at 10 cents. I can make 18 cents. I'm up 62% in this trade. Not too bad, right? And again, I think this is one of my newer trades. So I'll probably close this position today for a 62% profit. Now, Oracle is currently trading at about 50 bucks. So it would have to fall $16. I don't think Oracle's been at this price all year, and there's a lot of support here. So when I take these farther out trades, I make sure there's a lot of room between my contract price and when I sell it. All right, one last one. Let's look at Vail. Vail, I sold the right to have to buy these shares at $11 between now and September. I sold the right. I got paid almost 33 cents a share, so about $330. Well, here it is, $267. Right now, I could take a 51% profit in this trade, and so that would be $128. So what you can see here is all profit, all of these open positions I have. I've closed several positions, and like I said, 85% of them are winners. I had a few losers. Losers were all very small, and I'm happy to show those to you as well. But again, if I were to close all this out, 360, 450, call it 5, it's about $600 in gain from taking incredibly small amount of risks and very small positions. And I'm trying to keep these smaller positions so you guys can get an idea of what I'm doing and relate to it better. So I hope that helps. Oh, I'm sorry. One more thing before we go. I'm actually going to take a trade right now live, and I want you to see that. I mentioned to you that I took this trade on Decker. Okay, this was a very simple trade that I showed you where I simply sold. Let me pull that back up. Actually, sorry. I lost it again. Sorry. Oh, here it is. Okay, so I sold an option at $97. So if the stock drops below 97, I'll lose money. If it stays above 97, I'll make money. I like this trade. I like Decker. I like Decker for a lot of reasons, and I'm going to show you why I like Decker. I like Decker so much that I decided to take another trade. And this is the next level, maybe 2 or 3 levels up from what I'm going to teach you. But you're going to start trading these with me right away if you want. So let's look at Decker, this trade I'm going to take. Okay. Don't get lost in these definitions, okay? The trade I'm going to take is called an iron condor. You know what a put is. You probably don't know what a call is yet. But what I want you to see about this trade is I'm going to buy one. I'm actually going to own this. So I'm going to pay for this at $110. And then I'm going to sell one at $115. I'm going to get paid $5.15 for the one I'm selling. And I'm going to have to pay $3.15 for the one I'm buying. That's the put side. On the call side, I'm going to sell one for $120 because, again, I think the stock's going to stay above that or get above that, and I'm going to get paid $4.75 for that. And I'm going to buy one at $125, and I'm going to pay $3 for that. The net effect of all this mishmash is I'm going to get paid about $4 a share when I close this deal right now. I'm going to take this trade right now. I'm going to just take one contract, but $4 a share would be $400 that will go into my account right now. But without getting too technical for this first lesson, what I've done here is by buying one and selling one put, buying one and selling one call, all at different prices, I've encapsulated my win and my loss. This is the type of trade that I can go to sleep, wake up like Rumpelstiltskin, and I either, worst thing could happen. The market could go to zero. We could have a Black Monday. I can't lose more than 117. If the stock stays between my defined range, I'll make $383. That's a pretty good ratio. That's 3 to 1. That's what we want to look for. Now I want to show you this graphically because I think this will help. So this is the profit level, this purple line. So basically, as long as the stock stays between 110, let me go a different direction for you. As long as the stock stays between 111 and 123, I break even. That's a huge spread. You already know I don't believe Decker's going below whatever that support level was, 117, I think. I'm getting my numbers mixed up. I think this is a really safe spread for me. I don't see the stock going below 111. I don't see it getting much above 124. If it gets below 111 or above 124, I take a max loss of 117. If it trades, if you look at this purple line, let me move this here, between here and here, so between 111 and 123 is my break even. And as you start moving here, let's just say it traded between this section here, 113 and 121, I make money. My max profit occurs between 115 and 120. This is where I believe the stock will be somewhere between now and August 17th. And it's going to bump around. It's down 79 cents today, whatever. These are the types of positions that you'll sometimes hold till expiration because you know your worst and you know your best. These are the type of trades we'll do a lot of because nothing's risk-free. But knowing that you could only lose 117 and knowing you can make 123 and knowing you have this huge... So I'm going to take this trade right now. This is the basic order. If I click this button, this tells me that... and by the way, this is called a limit trade. So what it means is I don't want to do this trade unless I get paid at least $3.83 per share. So the market's either going to fill this for me or it's not. But this is where I like my risk the best, in the middle. Because if you just did a market trade, you might get paid $3.30. You could also get paid $4.30, but I typically will take the mid-range and I'll make that a limit order. So it basically says to Wall Street, don't bother filling this order unless I get paid at least $383. Sorry, $3.83. Okay, so review order. This tells me everything I'm doing here. It tells me how much I'm going to get when I place this order, and then I place this order. Okay, so we just entered this trade. Might get filled today, might not. Sometimes when I sell individual contracts, I'll do a market order, but these things get too complex, and so what you want to trade is the net that you're looking to have happen. Okay, I know this was a lot. I know it was like a lot of foreign language, but this was a good start for you. And again, I think the more that you trade along with me, paper it first, you'll start really getting a feel for what I'm doing and why I'm doing it. And the reason that I like Decker, let's just do this one last time. Let's pull up the chart. Whoops. Where's my chart? The reason I like Decker, remember the range, I said the break even for this trade is between 111 and 130. So as long as we hold support here, and as long as we don't get too much above here in this range, we get paid. That's a high probability trade because that's the range we've been in. So hopefully this makes sense. Hopefully you understand why I did what I did. If I were just selling a naked put, then I would absolutely have gone, and I did, as you know, I went all the way down here for protection. But because I did a more complicated trade and I protected my downside with this complication, I'm more comfortable taking a tighter range. Okay, hope this makes sense. Send me your notes. Let me know what you think, and I'll do this again tomorrow, probably much shorter.